This is the SPX market map, a peek at the week for February 2nd, 2026. First, a quick look in the rear view. The market closed Friday, January 30th at 69.39. Morning chop took price up near the 69.70 mark, followed by a downtrend into the afternoon. A sharp reversal took place off 6900. The rally topped out near 69.40 into end of day, where the index closed down about 30 points. The daily range was within bounds. The 21-day average true range is 65 points. Friday's close ended the week up about 23 points. In the bigger picture, the index logged a gain of 93 plus points for the month of January. No anomalies, just math. Let's have a look at the structural roadmap. Key levels for the upcoming week. The levels that show up on net market maker positioning include all the expirations for the week of February 2nd through the 6th. Some of the positions are significant, some not so much. The size of the positions influence the response of market makers, let's call them dealers, hedging concentrations of options gamma at different levels. The net market maker position chart confirms the structure visually. The chart doesn't show what will happen. It isn't a crystal ball, but it shows where market makers are more inclined to act, and those hedging flows help define the road ahead. Let's have a look at the upside first, the upper resistance zone. 69.95 to 70.40. Dealers are long calls at 70.50, more than 14,000 option contracts, but let's leave that strike off the map because zooming out to include it would change the view by making the other strikes look puny. They are not. The resistance zone marks the upper bound for anticipated price action this week. The 5 DTE straddle is about 110 points, so 70.50 is the strike at the top. 69. 95 is a level where price action could be anticipated to slow or reverse with an increase in volatility. The map shows an increase in positioning at 70.20 and again at 70.40. Next, let's take a seat in the stadium where 0 DTE traders will be placing their bets. The active trading range. 68.85 to 69.90. This range is defined by the 1 DTE straddle for Monday. Here's another thing about this zone. It's defined by a ladder of dealer short positions. What's the gist? Dealers in general are short calls above the current spot price and short puts below. Note the size of these positions relative to the size of the positions in the upper resistance zone. The positions in the active trading range may not pack the same punch as the larger positions above, but price action within the active zone is going to be driven by existing structure colliding with real-time 0 DTE flows. You're going to have to watch the flow to be in the know. Let's flip to the downside. 68.50 to 68.85. This is the zone below Monday's active trading range. Although it is flanked by dealer long strikes at 68.85 and 68.50, this zone contains dealer short puts. This is the bear den. You can use the dealer long puts at 68.40, about 1,500 option contracts, to gauge the size of the positioning. Finally, the lower bound, 68.40-ish. This zone marks the lower bound for anticipated price action this week and forms the bottom of the 5 DTE straddle. Analyze the visual information in the net market maker position chart and let the structure do the heavy lifting. Thanks for watching. Trade well